Welcome to this short video on management accounting. Today we're going to be focusing on what management accountants do and then looking specifically at the role of budgeting. So what do management accountants do then? Well, we can see accounting as a discipline that has two key strands. The first strand is financial accounting, which is retrospective, looking backwards, and focuses primarily on preparing and analysing the financial statements to analyse past performance. So when we cover financial accounting in the next module, you will see this in more detail. And it's very much focused on preparing those financial statements that are shared with key stakeholders and in particular shareholders. The second element is management accounting, and this is taking a more forward-looking perspective. It tends to be focused internally on helping people within the organisation make decisions and involves carrying out data gathering and analysis to aid future decision making. Management accounting is important for a number of reasons. Firstly, companies prepare data for use within the company to enable people to analyse that data, because the data can then be used to evaluate past performance, to make forecasts about future performance, and to inform decisions about pricing products and services. So if we tweak this cost or change this way of doing things, what impact will it have? Management accounting can also provide input to scenario planning, a topic that we'll cover in a later unit, to help make strategic choices. So for example, comparing the costs and income from a possible business expansion with an alternative investment in faster and more reliable equipment, which will be best for the company. This is all critical because companies have limited resources that they can invest, and the management accounting data enables them to evaluate those opportunities, so to choose between them and select from that wide range of choices. So narrowing down options and working out from a financial business perspective, which might be best. Let's look now at just one element of management accounting work, and that's budgeting. So a budget is a financial plan for a set period of time, which helps coordinate activities with each other and the strategy. A budget will say perhaps how much a company might spend in a period and how much money it might hope to make. If budgets are done well, they can assist with meeting goals because they help people to know where to focus. They can motivate staff members to perform better because they can provide targets to try to reach. They can encourage business managers to plan for the future by constructing the budget and working towards it. They can serve as a benchmark for performance, comparing the achieved figures to the budgeted figures, and they can help to communicate the plan so staff use local budgets to direct activities, so as a communication tool so that staff in local facilities can work out what's important and focus their efforts there. Budgeting can be seen as strategic because it has a role to play in the strategy process. In a company as a whole, you will establish first the mission and objectives, then analyse where the business currently is, evaluate options to close the gap between where they are and where they want to be, select the best option and formulate long-term plans. And then, and this is where budgeting comes in, implementing short-term plans that work towards achieving the long-term plans. So a budget will be a key part of this, helping to see what will be done in the short term and how that might be achieved. Budgets can also help with monitoring of the situation if you are performing to the budget, below the budget, or beyond the budget. And if performance didn't go as planned, then plans to correct it can be implemented, again using the information gleaned from the budget. So a budget can be seen as a short-term tool that's used to work towards achieving long-term objectives, with budgets usually operating for a period of a year or less. There are two budget approaches that we will think about in the context of core management concepts. The first is a zero-based budget, and this is where, when budgeting, all activities start with a budget of zero, and managers must fully justify why money needs to be allocated to that particular activity over something else in the company. So this means that the organisation doesn't assume, for example, that spending on training this year indicates a need for a similar amount next year, or that a budget for training is required at all. You start from scratch each time. An incremental budget, by comparison, uses the previous year's budget or results as a point of starting, and then you adjust from there to the amounts if necessary. So if, for example, it's expected that sales will increase by 10%, then 10% will be added to the previous year's budgeted sales figures to reach the new figure. So rather than starting from scratch, you work with what you had before and see how you might want to change it. There are different challenges with the two different approaches. So taking an incremental approach, that's the second one we talked about, where small tweaks are made, then all costs are assumed to continue, which may be foolish to make that assumption. Some cost savings may be possible and just ignored because it's easier to carry on going with what has been done in the past. With incremental budgeting as well, managers will often strive to spend all their budget to ensure that the incremental increase is based on the maximum baseline for the year. And it means that there's a disincentive to reduce costs because then the budget might be cut. With zero-based budgeting, there are a different set of challenges. Firstly, there's a risk of forgetting some costs that would have been automatically included in the incremental budget, forgetting the training costs, for example. It also requires more time and effort for managers because it requires more negotiation, more thinking, starting from scratch, and that can therefore usually be more costly to implement. So the budgeting process in itself becomes a bigger overhead for the company. Budgeting as a whole has some challenges as well. Firstly, it takes time and money, and for what, at what purpose? So alongside this programme, I also run the LSE's MBA Essentials programme as one of the head tutors. And so many of the students on there, when we talk about budgeting, groan about how in their companies it just takes them so much time and uses up so many resources when actually everyone should just be getting on with what they're doing. So there's some considerable cynicism towards big budgeting processes because the creation of those budgets can detract from focusing on the bottom line or getting on with what you're supposed to do, and it can also lead to irrational behaviour, and why would you want to encourage that? Budgets can also become irrelevant very quickly. So for example, if there was a new competitor for a Kindle, then you might totally change the way that you as Amazon hold the budget for the Kindle. Or if there's a regulatory change in holidays following COVID, then you've got to seriously change your budget as a travel company about how much you expect to make and what costs you're likely to incur. Or internal changes, if you lose expertise, then your budget you might have a chunk in your budget for marketing spend, but if you haven't got someone who does marketing because the marketing person's left, then how are you going to spend that money? It can also become a game. So if you're paid based on how well you meet your targets, then you tend to set your targets low. So if you're paid for meeting but not exceeding your budget, then you will be gaming the system. If you know you'll get a smaller budget, if you don't spend everything this year, you'll spend it. I remember working on a project at a university, not LSE, and there was budget left from the project for that particular year. And all of a sudden, we all had new computers because it was either spend the money and then hope to get the same money in future, or don't spend the money and don't stand a chance of having as big a budget in future. Anything that's a gain is ultimately bad for business. So budgeting is important to managers for a number of reasons. Firstly, it helps them to ask and answer questions around how much they can spend, what do they need to make in what quantities, what can they expect from their people. It forces them to do some joined up thinking with other departments so that they can discuss their budget versus and in relation to other budgets. It can provide a good insight into strategic imperatives, so what's important to the company, and it can provide a way of correcting things as they go wrong and you compare to the predicted budget versus where you are at the moment. Thanks very much for listening to this session on budgeting and on management accounting, and I hope to see you in a future session.